Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.7 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we are going to cover what slippage and its impact on backtests means, a simple real-world example, common mistakes, and a practical step-by-step way to apply it. We'll also explore how slippage connects to risk management. By the end of this video, you'll have a solid understanding of how to incorporate slippage into your trading strategy. So let's get started. We'll begin by defining what slippage is and how it affects traders. Slippage refers to the difference between the expected price of a trade and the actual price at which the trade is executed. This can happen due to various factors, such as market volatility, liquidity, or order book imbalances. As a trader, it's essential to understand slippage and its impact on your trading performance. In the next scene, we'll dive deeper into the concept of slippage and explore a real-world example. Now that we've defined slippage, let's consider a simple example to illustrate the concept. Imagine you're trading the euro to US dollar currency pair, and you want to buy one lot at a price of 1.1000. However, due to market volatility, the price jumps to 1.1005 by the time your order is executed. In this scenario, you've experienced slippage of 5 pips. This might not seem like a significant amount, but it can add up over time and affect your trading performance. To put this into perspective, let's consider a real-world example. Suppose you're trading with a strategy that generates 10 trades per day, and each trade experiences an average slippage of 5 pips. Over the course of a month, this can result in a significant loss of capital. As a trader, it's crucial to understand how slippage can impact your trading performance and take steps to mitigate it. In the next scene, we'll explore a real-world example of slippage in action. Let's take a look at a real-world example of slippage in action. Suppose we're trading the euro to US dollar currency pair, and we set a buy order at 1.1000. However, due to market volatility, the price jumps to 1.1005 by the time our order is executed. In this scenario, we've experienced slippage of 5 pips. To mitigate this, we could adjust our trading strategy to account for slippage. For instance, we could set a limit order at 1.0995, which would give us a buffer of 5 pips to account for potential slippage. By doing so, we can reduce the impact of slippage on our trading performance. In the next scene, we'll discuss the most common mistake beginners make when it comes to slippage and its impact on backtests. One of the most common mistakes beginners make when it comes to slippage and its impact on backtests is ignoring it altogether. Many traders assume that slippage is negligible and won't affect their trading performance. However, as we've seen in our previous examples, slippage can have a significant impact on your trading results. By ignoring slippage, you're essentially flying blind and leaving yourself exposed to potential losses. To avoid this mistake, it's essential to incorporate slippage into your trading strategy and backtesting. In the next scene, we'll explore a practical step-by-step way to apply slippage and its impact on backtests. So, how can you apply slippage and its impact on backtests in a practical way? The first step is to understand your trading strategy and the markets you're trading in. This will help you identify potential areas where slippage may occur. Next, you need to determine the average slippage you're experiencing in your trades. You can do this by analyzing your trading data and calculating the difference between the expected and actual prices of your trades. Once you have this information, you can adjust your trading strategy to account for slippage. For example, you could set a limit order at a price that takes into account the average slippage you're experiencing. By doing so, you can reduce the impact of slippage on your trading performance. In the next scene, we'll explore how slippage connects to risk management. Slippage and risk management are closely connected. When you experience slippage, it can increase your risk exposure and potentially lead to larger losses. To mitigate this, it's essential to incorporate slippage into your risk management strategy. One way to do this is to adjust your position sizing based on the potential slippage you may experience. For example, if you're trading a strategy that's prone to slippage, you may want to reduce your position size to minimize your potential losses. By doing so, you can reduce the impact of slippage on your trading performance and better manage your risk. In the next scene, we'll discuss a real-world case study of how slippage affected a trader's performance. Let's take a look at a real-world case study of how slippage affected a trader's performance. Suppose we have a trader who's using a scalping strategy to trade a euro to US dollar currency pair. They're experiencing an average slippage of 5 pips per trade, which may not seem like a lot. However, over the course of a month, this can add up to a significant loss of capital. To mitigate this, the trader decides to adjust their trading strategy to account for slippage. They start setting limit orders at prices that take into account the average slippage they're experiencing, and they also reduce their position size to minimize their potential losses. By doing so, they're able to reduce the impact of slippage on their trading performance and improve their overall results. In the next scene, we'll discuss another common mistake beginners make when it comes to slippage. Another common mistake beginners make when it comes to slippage is overlooking liquidity. Many traders assume that liquidity is always available, but this isn't always the case. In reality, liquidity can be a major factor in determining the slippage you experience. For example, if you're trading a currency pair with low liquidity, you may experience larger slippage due to the lack of buyers and sellers. To avoid this mistake, it's essential to consider liquidity when developing your trading strategy and to adjust your strategy accordingly. In the next scene, we'll explore a step-by-step guide to adjusting your trading strategy to account for slippage and liquidity. So, how can you adjust your trading strategy to account for slippage and liquidity? The first step is to analyze your trading data and identify areas where slippage is occurring. Next, you need to consider the liquidity of the markets you're trading in and adjust your strategy accordingly. For example, you may want to avoid trading during times of low liquidity or adjust your position size to minimize your potential losses. Once you've adjusted your strategy, you need to backtest it to ensure that it's performing as expected. By doing so, you can reduce the impact of slippage on your trading performance and improve your overall results. In the next scene, we'll discuss the importance of backtesting your trading strategy. Backtesting is a crucial step in developing a trading strategy. It allows you to test your strategy in a simulated environment and identify potential areas for improvement. When it comes to slippage, backtesting is especially important. By incorporating slippage into your backtesting, you can get a more accurate picture of how your strategy will perform in real-world markets. This can help you identify potential issues and adjust your strategy accordingly. In the next scene, we'll explore a real-world example of how backtesting can help you improve your trading performance. Let's take a look at a real-world example of how backtesting can help you improve your trading performance. Suppose we have a trader who's using a scalping strategy to trade the euro to US dollar currency pair. They've developed a strategy that they think will perform well, but they want to backtest it to ensure that it's profitable. They incorporate slippage into their backtesting and discover that their strategy is actually losing money due to the slippage they're experiencing. To adjust for this, they decide to modify their strategy to account for slippage. They start setting limit orders at prices that take into account the average slippage they're experiencing, and they also reduce their position size to minimize their potential losses. By doing so, they're able to improve their trading performance and increase their profitability. In the next scene, we'll discuss the importance of continuous learning and improvement. As a trader, it's essential to continuously learn and improve your skills. The markets are constantly changing, and what works today may not work tomorrow. To stay ahead of the curve, you need to stay up to date with the latest market trends and adjust your strategy accordingly. When it comes to slippage, continuous learning and improvement are especially important. By staying informed about market conditions and adjusting your strategy to account for slippage, you can reduce the impact of slippage on your trading performance and improve your overall results. In the next scene, we'll summarize the key takeaways from this lesson. In this lesson, we've covered what slippage and its impact on backtests means, a simple real-world example, common mistakes, and a practical step-by-step way to apply it. We've also explored how slippage connects to risk management and the importance of continuous learning and improvement. By incorporating slippage into your trading strategy and backtesting, You can reduce the impact of slippage on your trading performance and improve your overall results. Remember, slippage is an inevitable part of trading, but by understanding and adjusting for it, you can stay ahead of the curve and achieve your trading goals. In the next scene, we'll conclude the lesson and provide a call to action. That's everything for Lesson 11.7, Slippage and its impact on backtests. If this lesson has helped you understand the importance of slippage and how to incorporate it into your trading strategy, be sure to like and subscribe to our channel for more lessons and trading tips. In the next lesson, we'll cover another important topic in algorithmic trading. Thanks for watching, and we'll see you in the next lesson.